Good morning, everyone. Welcome to this update for global stocks and commodities for the 13th of January. The edition this week is titled that the outlook is neutral. That doesn't mean that I don't think anything's going to happen. I think, to the contrary, I think there is still plenty of trigger points out there. We've got the Brexit vote next Tuesday. We've got the China trade deal. We've got the US government shutdown. There's just any number of triggers out there. So I think plenty of things are going to happen. But I'm calling it neutral because I really don't have an opinion about either the short or the medium term direction of the market. And in fact, I'm deliberately trying not to because I just think it's complete guesswork. I think trying to make a prediction is just try to make a hero of yourself. I think it's silly. And we need to just really play the market as it presents at the time. I've got some very firm views about where I think the low risk opportunities and growth are, and I think they're starkly obvious to me, and I'm pursuing them, and I'm pretty excited by them. But in terms of actually trying to formulate an opinion on where the market goes in the next month or 3 months, I'll opt out of that. So let's jump in and take a look. So really this update is just about resisting the tendency to need to know what's going to happen next. You really don't need to know. There are things that you can do. There are strategies you can adopt that you just don't need to know where the market's going to go. You can just sit back with a pretty good sleep at night factor and make some reasonably good returns. So I think that's what you should be seeking. There's plenty of low-risk growth out there now. We've seen a lot of the world's best companies with market caps well in excess of $50 to $100 billion have pulled back by more than 20%. And some of them anything up to 30 or even 35% in this correction. The businesses are largely unaffected. They've just become great value. So there's plenty of low-risk growth out there, so don't be put off by the headlines and the negative sentiment around the market. I'm not saying that you should go fully in, but there are certainly great opportunities out there. We'll look at the normal stock and commodity trend update. And last week in Portfolio Analyst, apart from answering a number of very good questions from members, I went through all of my high conviction stocks, both in Australia, predominantly in Australia, but to a degree in America as well. And these businesses I think are still going as well as ever. They just got cheaper. That's the only thing that's changed. But also importantly, I covered what to avoid because it's just as important to stay out of trouble as it is to get into stocks that are going to give you a good return. Because if you can avoid a stock that's going to go down 20% or 30%, then in a way, that's a profit, isn't it? It adds to the profitability of your overall account. So what to avoid is just as important as what to get into, and I certainly looked at that last week in Portfolio Analyst in some detail. All right, the S&P continued its rebound for the second straight week, up 2.5%. Market sentiment has improved a little bit, but it was just so dire leading into Christmas that it really only had one way to go. And the last 2 weeks is really just what you'd expect from extreme oversold. Would have been highly unusual if we hadn't had a rebound over the last couple of weeks. So, don't get too excited about the rally. Prices have now stalled at what is pretty key resistance, maybe here, maybe just a little bit higher. It's all a very concentrated resistance zone. And again, the most likely outcome, and this is not a prediction, this is just an observation of how markets operate because that's how human psychology operates. And that is that we will get some sort of retest of the December 21 low. And I think that's still the most likely outcome. Now, whether that's to a higher low, an equal low, or a slightly lower low, I have no idea, and I'm not actually spending any energy thinking about it. My game plan takes care of it. it can accommodate it very, very comfortably. In fact, it would almost suit me better to get a little bit more market downside. And that's really how you need to position yourself in these sort of markets. If you're positioned otherwise, then you're constantly going to be on edge. You're going to be agonizing about every move in the market, and you're going to make mistakes. So it's very important to try and position yourself so that you don't actually care too much whether the market goes up or down in the short term. Avoid projections. Just go with what is, and you'll be in much better shape than if you start trying to formulate an opinion about where the market is going. US dollar slightly weaker because the Fed is making dovish comments now about the interest rate outlook. The Fed has clearly stated that they're beholden to the markets now. If the markets sell off, the Fed is going to back off. And, that's quite an extraordinary situation to have reached. Now, I think it's in the very long term, I think that's a very bad outcome because it means that excesses don't get dealt with in the normal economic fashion. I mean, that's how economic cycles work. Excesses build up. There is then a process of readjustment. Part of it is market driven, part of it is central bank driven. But if we've now got a situation where the central banks are just going to keep forestalling the inevitable removal of those excesses that have been built up over the last 2 or 3 decades, then eventually there's going to be an even bigger bang. But that could be in any sort of indeterminate time period in the future. Could be 2 years, 5 years, or 10 years, or even longer. But I just feel that with central banks continuing to back off, to try and hold everything up, never have a recession, I just think is going to end very badly at some point in the future. But look, in the meantime, we can just put our head down and make some good returns. Now, the US dollar slightly lower on the week, and the Treasury yield, the 10-year, was pretty steady around 2.7. So let's take a look at that market action. So the S&P, this was the February lows, which was a really sharp correction, but was really only a correction of just an extraordinary excess that built up over this 2 or 3 weeks through here. If you look at the long-term trend, so you can see this long-term trend line that existed pretty much all through 2017, then all that happened was we got way ahead of it, we got well below it, and then we eventually came back on track. So by October of 2018, we were still in the same position on trend that we'd been in for nearly the 2 previous years. So if you ignore this as being an initial correction point, if you like, because it was just correcting some excess, and it didn't even breach the 200-day moving average on a closing basis, then we can move forward to here and say, well, okay, this is now the correction low. So this is now set the new line in the sand that we don't really want to see broken. Now, this is all a matter of interpretation, and I'm not trying to sugarcoat it, but if we do look at how this compares to 2015, 2016, so this is that period here. So the first plunge low in 2015, as you can see, significantly broke the 200-day moving average. It was miles underneath it. So to me, that was a valid first correction, whereas this is a bit of a different scenario. We didn't even break that 200-day moving average. So I'm giving the market the benefit of the doubt at the moment. I'm setting this as the new line in the sand, 23.50. I believe a break of that on a meaningful basis will signal a bear market that will last for a period of, perhaps a year, couple of years. Now, we've had a rebound. We've come back to resistance levels. So we've got resistance at this level here, which was December 10, some resistance from late October, We've got some moving averages here that are important. So we're all in this zone here, just above and below 2,600 points, which is key resistance. Now, I am expecting that we will get some sort of retest of the lows. So we'll come down somewhere into this area here. It's pretty broad, but I think that's a reasonable expectation. So that's the US market. US dollar has pulled back a little bit, and that's really all about the expectations around the Fed's rate of interest rate increases. And it's now likely, the way things are starting to shape up, that the interest rate rises now in 2019 is probably going to be nil. And if things do fall apart a bit, then we could even see an interest rate reduction. Certainly, the Fed now has effectively signalled that their bond buying program, which they had described, Jeremy Powell had described in October as on autopilot, and that was the trigger for the April correction, for the October correction, I should say. That was the single biggest contributor to the start of that correction. And then, of course, as soon as he backs away from that position, then the market has rebounded over the last 2 weeks. So it's pretty clear about what is driving the market at the moment. But an investor can't frame their strategy around Fed policy decisions which flip-flop backwards and forwards. That's an incredibly unwise thing to do. So as I said right at the start, find a strategy, find an approach, position yourself so that it really doesn't matter too much what the market does in the near term, up or down. All right, while we're here, let's just have a look at the Australian market. We've had a really nice rebound from the 21st of December, and we've come back into this range between 5,600 and 6,000 points, and possibly likely to stay there for a bit of time. The Aussie dollar edged up, of course, with the weakness in the US dollar, and we saw a bit of improvement in commodity prices as well. So we came from the flash crash low of 67.5, and we're back to 72. Now the index up 154, 2.8% for the week. But as anyone that's been watching this for any period of time knows, that I rarely have a focus on the top 50 to 100 stocks. There's a few that I own, but not because they're in the top 100 stocks, merely because they're great businesses in their own right. But most of my focus remains in two areas. The very heavily undervalued growth stocks that are large enough to be in the top 200. It's not because they're in the top 200. I'm just making an observation that they are not small stocks, but they've become heavily undervalued because of fairly bearish market expectations of their outlook, which I think are in error. And secondly, there are some great micro-cap stocks that are really strong growth stocks in Australia. Now, the share prices are currently doing very little because liquidity has dried up, and that always happens in corrections. We'll come out of that period, and these businesses are still barreling ahead. They're growing their earnings at 50% plus, 100% plus a year for at least the next couple of years. And at some point, sentiment will shift, and these share prices are absolutely going to rocket, because some of these stocks now are valued on P's of less than 10, and they're growing their earnings at almost triple-digit rates. So it doesn't take too long for that reversion to kick in. So this is one of the things that I'm really seriously focused on in Portfolio Analyst, is these growth micro caps, and also in my other main subscription service as well. So I think there's tremendous long-term opportunity, but you've got to be patient. All right, turn to precious metals. Gold was up just $3 to $12.88. And we've got a continued battle between the currency, the US dollar, and the perceived risk outlook. When the perceived risk rises, gold rises. When the perceived risk falls, then gold will go with that. And of course, inverse to the US dollar. Precious metal stocks, stocks still improving slowly. There's not a great deal happening there, but it's showing some promise. So there's the US dollar on a weekly basis. We've definitely got a short-term uptrend. We need to break above 1385 to signal a renewed uptrend, but I think there is enough evidence there to think that it's quite possible. GDX on a weekly chart, again, it's just slowly. It's not really leading the way, which is what I would over here in 2016. This was really the sort of thing that you'd like to see, where the gold stocks really led the way on gold. But there's always time for this momentum to pick up, and we have got strength in the US dollar, which has been holding things down. The Aussie gold producers are overbought. I think they're a good opportunity, but I certainly wouldn't be buying into them or adding to them at this point in time. But certainly keep your eye on Aussie gold producers. Copper firmed a little bit to 271. Crude oil recovered from the depths of the crash, around 45. So we've had a 14% rebound in the last 2 weeks from very deeply oversold. There's the spot copper chart, and not a lot of change in the LME copper warehouse levels. London Metal Exchange still remains around 5-year lows. And there's crude oil with a rebound from under 45, got back above 52 for a short period, and then eased back a little bit. So to wrap it up, no time to be stuck on preconceived ideas or strategies. Just work with what's in front of us. Just try and be neutral in your outlook. Don't have expectations about the market going up or down. And that is why I think the covered call strategy that I've been talking about in various forums is just such an ideal strategy at the moment. It's lower risk than owning stocks. It's probably going to be more productive than owning stocks in a volatile environment that doesn't go anywhere net. I just think it's hard to beat at the moment. US earnings season just starting. It could be the defining aspect for the US market. The expectations for earnings growth are pretty bearish. If companies can come in a little bit better than that, I think you'll see some upward adjustment in prices. The S&P corrected 19% from October, but most stocks by much more. There weren't a lot of stocks. It was really only the ultra defensives, the sort of stocks, the utility stocks that you tend to see do well in horrid market conditions. But most stocks in the S&P corrected by more than 20%, and some of them a lot more. We got the Brexit vote on Tuesday, and then whatever follow-up aftermath occurs after that. That could be a major market mover if we end up with what's called a hard Brexit. Then that could be a nasty market mover, but that's only a possibility at this point in time. Portfolio Analyst this week, I'm just going to continue looking for low-risk, solid reward opportunities. And there are some great ones. Some of the world's truest blue-chip stocks are now at very attractive valuations. They're probably stocks in the US that I've been following for several years, but I just refuse to pay the 20 to 25 times PE, are now back to around 15, 16. That's attractive. And some of them are paying dividend yields in the US of around 4%, which is also extremely attractive for the US environment. So there certainly are great opportunities out there, and that's my task in Portfolio Analyst, and my other Service Insiders Club is to identify them. That's it for this week. There's my contact details, and I'll be back with you next Sunday. Cheers.